Test, 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 test. Test, 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 test. Test, test. All right, go. Right. So today, welcome to another stream. Today we're going to be doing something a little bit different. We're going to be trying a Fermi problem for startup investing. So I have this pulled up right now, but Fermi problem is a kind of estimation where basically you're using a bunch of guesses layered together in order to calculate a number or get to some kind of conclusion. So making justified guesses about quantities and their variance or lower and upper bounds. Order of magnitude estimates can also be derived. So an example of this is, what is the mass of all the automobiles scraped in North America, right? And what you do is you break it down into, okay, well, how many vehicles are there? What is the mass of each vehicle? How many of them are getting scrapped, and so on. And you come up with estimates for each of the different subcomponents, and then once you do that, you can actually do the math and then get a final number. And the kind of the secret behind it is that you're using these lower and upper bounds, right? And as long as you have reasonable lower and upper bounds that span orders of magnitude, your final guess will actually be within the order of magnitude that you want. It might not be the correct number, but it'll be within one order of magnitude. So we're going to be doing that to answer the question. The question we're answering, let me make this a little bigger here, is startup investing in 2023 worth? So this is something that I've been asking myself, and in my circle are thinking about this, so I figured it made sense to kind of do a little back of the envelope here. So I have a couple different charts pulled up here that show kind of historical returns and current state of returns for startups. But maybe the first thing that we want is a baseline. So our baseline is the return on ETF per year. Or not ETF. Actually, maybe here. So our baseline is going to be how much money could you make if you just put your money into some ETF or index fund, right? So these are basically just very generic funds that are kind of diversified maximally and invested for you, so you don't really have to do a ton of thinking. So we have here the returns. Average returns of the S&P 500. Take this, copy that, we're going to put it here, shift paste it, and actually why don't we open up a little VS Code here. Documents, betterer, and make a directory here called finance. Go into that directory, then there. Now let's open up a code. Open up what we just made. Finance. Let's make a new file in here. And save this and say startup Fermi problem.py. Okay. The GitHub Copilot is on, so I was just laughing because I see that it's auto-completing. Fermi caps lock on. Fermi problem for startup investing. Okay, so sure, we can numpy, import matplotlib, sure. Fine. So let's say make our baseline, which is we're gonna call it S&P 500 baseline. Okay. And here let's cite our source here. And let's do return ROIC. ROIC per year. And we're going to make this a dictionary. We're going to copy paste this stuff. So in a lot of kind of investing stuff, people will give you this generic 7% return per year. But the reality with that is that that's not actually how it works. Like you can see here, the average being 7 is kind of nonsense. At the end of the day, there's a lot more variability than people give it credit. You can have 12% 1 year, and then 0, and then 13, and then 29, and then negative 1 year. So we're going to make a dictionary, and then we're going to say, let's say you have capital. Let's do some typing here. Typing, import this. We'll import all of it. So we're going to be getting in a float, which is the total amount of money. And then we're going to be outputting a float, which is the amount of money that you get back. So this Copilot is trying to do the let's do randomly select a year. The S&P 500 this year returned RIC per year of year. Calculate the return. New capital, or let's call it end of year capital, equals 1 plus the return per year. I think this is percent, so you actually to be 0.16. You want 0 point. You want negative 0.0 here. We're gonna divide these 100 here. That's what I'm doing. 4 negative 0.0073, 0.11.39, 0.296. Very good year. 0.1341, 0.0, and then 0.1278. Capital plus that, you don't need over 100, and you do that. Your capital, your index fund investment of capital is now end of year capital. Okay. So let's just call it S&P 500. So we have a little function here that calculates kind of how much money we make from the S&P 500. So we run the simulation here. We start with, let's say, $1,000. Start set the initial capital, start capital. And then let's also do our investing per year. New capital, say let's say $10,000, and you start with $100,000. So you have $100,000 start, and you're investing $10,000 every year. So number of years to run simulation. You have num years, let's say 10. And you're going to say 10. So at the end of the year, you first start with your capital equals, or start capital plus new capital it's going to be this. Then you run it for however many years. At the end of year, you have something like that. And then capital, end of year capital plus new capital. Actually, let's put this ahead here, right? Start. Start with your start, then you add the new one, invest it, end of. Okay. So, go ahead and run this. All right. So, here you can see that here we're returning a slightly different amount. And you can see how the return here upgrade. So the end of the year, right? You're investing 10,000, or you start with 100,000. You invest 10,000 every year. Do that for 10 years. At the end, you end up with 429,000. Right. So this is our baseline. Oh. How much money would you get investing? All right. It's at point F, I think. Let's ask ChatGPT. Let's open up. Log in again. Okay. Can you modify this print statement such that it rounds to 2 decimal places? Call this S&P 500 for 1 year in S&P 500. And okay. So now let's do 1 year startup. So this is much more complicated, right? Because Startups don't return the money immediately. There's a much longer delay. So here are some charts, alternative capital here, that show the return on invested I think is total value per invested. Total value to paid in. The ratio of the current value of remaining investments within a fund plus the total value of all distributions to date relative to the total amount of capital paid into the fund date. So it's basically a multiplier of how much money returned. So you can actually see here, this gray bar is the total value returned, and then you have different years, right? So in 1997, the VCs were making roughly 3x what you were putting in. And then it kind of really dipped down here in the early 2000s, just barely making 2x. And then it kind of climbed up a lot. And kind of the peak here was 2011, 2012, 2013, where you had almost a 5x return. And then it went down here 2012, 13, 15, and then it's kind of gone back to where it was in 1999 or the year 2000. So how can we how should we design this function to kind of approximate this, right? I think there's a couple different we're going to have some notion of what the lockup period. So we're going to have our capital in. Lockup period. Number of years. Before you pull it out. What else? There's a percent for death chance, right? Oh. Percent chance that startup fails. Money is minimum time to a liquidity event, right? So when you invest in startups, right, this lockup period could be years, right? Because a liquidity event is either a IPO or an acquisition. At some point, there's going to be some event where basically your shares in that startup can be converted into actual dollars. But that can be as early as like 5 years, but it can also take up until 10 years. So kind of an unknown period there. So maybe instead of making these orgs, let's put these in. So let's say random dot form, I think int uniform, right? And maybe we can say 4 is the smallest amount of years until you get a return, and then maybe something like 10 or 8 years until the longest. So lockup period is somewhere between 4 and 8. Failure chance int. This is float. See if we can find a good value for that. Percent chance startups fail each year. YC. Years 2 through 5, with 70% failing into the category. Okay, so I think failure chance is actually better as a dictionary, where the percent chance will change as your goes on. So in year 0, have a 50% failure chance. 1, 2, 3, 4, 5, 6, 7, 8. It up until. So I think here we see years 2 through 5, we have 70. So here and this is 0 indexed. So from here to here, almost 70 failure. 50% chance of failure initially. Then, I don't know, we'll do a 10% chance of failure. Past that. Okay, so I think we're actually going to modify our S&P 500 baseline. And we're going to take this code that we had here, and we're going to put it in. Actually, no. What we're going to do is we're going. We're going to call this multi-year S&P 500. You have your capital in, you have some number of years. We also have our new capital. Don't need. Actually, why don't we actually give it the year? We have a fictional S&P 500 in year. return the final capital. Investment is let's just turn on S100. Value of your capital S&P 500. Okay, so that's our multi-year and our 1 year for S&P 500. Now let's do our 1 year in a startup. And have some capital in, have the number of years. And I think we're going to run this this is going to be like a single startup. Have your lockup period, failure chance. Now we need a valuation. Valuation growth per year startup. Some random bullshit. They didn't actually give us part evaluation. Startup valuation, multiple. Because you also get diluted too, right? So let's use this here. So this is the Y Combinator ownership of Airbnb, and roughly how much they were making, right? So in 2009, they had 6% ownership, and the valuation of Airbnb was at 2.4 mil. So you can see here how their ownership actually decreases because they're raising more rounds, so they're diluting their total ownership, but 6% of 2.4 mil is way less than 3% of 30 billion, so that's how the math kind of makes sense. So let's say a value of investment at the end of how do we want to do this? I think we can come up with a simple model here. ROI for tech startup. Oh, here we go. Startup survival rate by funding. Let's just say that you run it for the number of years. Year and number. First thing you do is if random dot random, your startup failed in blank. Okay, so this is the give these startup name. Call this Zero, or actually even better, startup Lee. Okay. Startup name failed in. All right, if it doesn't fail, this is going to be a range of. Then looking at these valuations here, right? So roughly 2x every time. But it's not every year, right? So like startup growth per year. $10 to 25% per year. Maybe we do a growth rate of startup. And why don't we add even more randomness? So revenue growth of 120%. 0.2. 83 in the second. 80% in the third. You have a plot that we can use here. Somewhere around. Actually, add even more randomness. Random.random. So I think on the low end, median growth rate, average growth, somewhere between 50% growth, what they have here is 8% growth, and kind of the big growth would be 1. So that for all of these here. Second year, you have 45% to about 95%, or 93% growth. Then you get to about 0.80%. And kind of starts capping out at that. So 50%, 40%, 30%. Yeah, and then I think once you get to like, here's DoorDash, right? 600, 700, 0.44, 7. It kind of stops growing 10 years in here. This is the growth rate of late stage startup. Stage, industry, location. Maybe this isn't in the spirit of Fermi problems. I would say that maybe 20% growth rate per year, kind of. I would say that's on the reasonable side of the upper bound, and maybe the lower end here is we'll add the possibility of a down round. So you can go down once you get to the top here. So I think in the last 5 years down, and then here there's possibility of a flat round. Maybe not. Okay, so this is my Fermi problem estimate of the growth rate of a startup per year of life. And let's also do something. I think that's already there. Okay. So we're going through the number of years. If year is less than lockup period, your startup is still locked up. Not year is less than lockup period. Your startup is still locked up. Maybe let's not do this lockup period. I think this is gonna just make it more confusing, right? Because then the problem is that you have to account for decision making there, right? Because you leave your capital in and let it grow more. Do you not? So let's just do our guess based on the kind of growth rate and the failure chance. So, if no more if, then we say calculate the return. Have capital equals capital times 1 plus growth rate for the year. Okay. Grew by blank percent in year that. Your investment is now capital. Okay, and if you make it to the end, startup made it to the end of the simulation, your investment now. Okay. So let's verify, run the simulation with the S&P 500. Make sure that that still runs. Change num years to start year. Right. So this is the S&P 500. $831,000. This was a good year. Got 28% multiple times. Good 10 years. Let's run the simulation startup. And I think with startups, you're gonna want multiple startups, right? So multi year startup. Okay. There's keep it capital, num years, and new capital. And this should. So how many startups are you investing in? 10. Investing in per year. Startups. For startup in range. Year in. Capital plus equal. Let's just say you invest in 5 startups initially. So invest 5 startups to begin with, right? So let's say you startup. Here you have capital 5. Investing 1/5 of your capital. The num years are the same, and then we're going to have here all of the investment startups 5 investment per startup that capital and let's come up with startup names. That's the part, right? Have Juicero, have Opti, let's have Ephemeral, have Tulio, and Web 5. Okay, so those are our 5 initial investments. And then our new capital every year, we want to split it. So then, wrong. Actually, why don't we invest in startups to be investments, and additional investment every year. So then after your initial 3 investments, make a little function here. Startup name generator returns a string. Field name for name in. This is like kind of terrible Python code, but good at that. Go. See what it autocomplete. Blink, Pebble, Clout, Gawker, MySpace, Groupon, Zynga, Dropbox, Instagram, Snapchat. All right. Name. Startup name dot net. Okay. So these first 3 investments all go for a num years amount of time, but then every successive investment only receives new capital, and it only goes for a shorter amount of time. It only goes for num year minus year. Minus year. And the value of your capital in the startups is capital, if that works. Comment this out. Generator. Drainerator next. Totally fine. Like, why does it not like this? You have to use built-in function. I see. Being a Python 2 person going on. Random.random takes no arguments, so I think it's uniform. Go. Okay, so your startup Juicero grew by 1.1% in year 0. Your investment is now 70,000. Startup Juicero failed in year 1. Your startup Opti grew by 1.1% in year 0. Your investment is now 68,000. How startup Opti failed in year 1. Startup Ephemeral failed in year 0. Your startup Tulio failed in year 0. Blink failed in year 2. Pebble failed in year 0. Cloud failed. Fun failed. Failed. Instagram failed. Okay. It seems like the failure rate is a little bit too tuned here. Let's say maybe the chance of failure in the first year 30%, down a little, 50, 50%, 20. Okay, it's bought these. Run the nations 100 times. Plot the results. All right. Okay. Put it up here. Running this 100 times each. Go. Our final chart, dudes. Yeah, and it's kind of exactly what you would expect. I think you could have probably come to this conclusion yourself, but basically, investing in startups, you have a low chance of returning a lot, but a lot of chance of returning nothing, potentially even negative. So let's come back here and let's say, let's here instead of the capital 1 year SM 500 multi-year SM 500, let's turn return on invested capital. So total capital invested is cap in capital plus capital okay. The total return on investment capital minus capital in over capital in ROI. Print ROI on your for the multi startup. PLT dot ROI after years. PLT.x label is the ROI and PLT.y label. Right, let's run this. Yeah. Let's run this 1,000. And let's find print and replace with hashtag print. This is a very quick way to comment out all your print. So after 10 years, you're kind of roughly expected to somewhere between 1.5 and 2x your money if you put it in the S&P 500. If you're putting it in startups, you're mostly losing money or going even, but there's a very small chance that you make 6x your money here. So that's the conclusion. What else can we add to this? I don't know. I think anything we do is just going to kind of shape these curves a little bit. Maybe let's kind of look at what we have here. I mean, it's kind of what we're seeing. The best return ever that you can expect from startups is around 6x over a 10-year fund. And this number here, DPI average, just under 2x, is basically slightly above the S&P 500. Cool. So that was a fun little problem. Let me push this Python code, but yeah, I think the conclusion is that startup investing is risky, and unless you feel like you're very, very good at picking the winners, you're probably just going to lose all your money and get fleeced. So